Hello, my name is Gary Kawano, and I'm going to do a short video explaining CalHFA's California Dreaming for All. But I'm eligible to do financing throughout California. Program highlights. Why are people interested in this program? Why is it so popular? Why did it run out so quick when it first got released? And the answer is the size of the down payment you're eligible to receive. It's up to $150,000 or 20% of the purchase price, whichever is lower. So I gave a few examples. $500,000 sales price, $100,000 down payment. $750,000, $150,000. If you go up to $800,000, caps at $150,000, so you're not quite 20% down. So you'd have to come up with either money out of your own pocket or you'd have mortgage insurance. And this is not a who gets in first going to get the money. You have to get in, doors open, and then it's a lottery. Who qualifies? You can qualify as an individual, you can qualify as a couple. If you qualify as a couple, at least one of you has to be a resident in California. Both you have to be first-time home buyers. And first-time home buyers are defined as someone who has not owned a home in the last 3 years. Also, you have to be a first-generation home buyer. And I think this is going to eliminate a lot of people from the pool of applicants. You can't own a home in the last 7 years, and your parents cannot have owned a home in the last 7 years. If your parents passed away, they could not have owned a home at the time of their passing. So again, that's probably going to eliminate a lot of people. Also, you can't make too much money. So I picked San Diego. In San Diego, if you're applying as one person or two people, incomes added, you can't be over 185,000. Every county is different. If you want your specific county, I can email you specifics to your county. So let's say you're selling the call, you're still watching, you do qualify. Let me explain how the actual program works, see if you're still interested. It's very innovative, very unique, but it's a little confusing. So there's 3 components to it. One is your typical first mortgage, pretty straightforward, 30-year fixed, vanilla loan. 2 is a down payment assistance. Buying a home for $500,000, the $100,000 down payment, that's a loan you have to repay, but there's no payments until you trigger something that's called a maturity event. At that point, you need to pay. We'll go over in detail that. What's most confusing is this shared appreciation amount. So if you buy a home for 500, later you sell it for $1 million, that 500,000 in equity, you're splitting a percentage of that with CalHFA, and I'll get specifics on that. So I mentioned income. You can't make too much money. The income's classified in 2 different categories, low income and moderate income. We look at the the area median income for the county, and we take, if you're 80% of that or less, you're classified as low income. If you're between 81 up to 120% of that, you're classified as moderate income. If you make more than that, you're ineligible for this program. So in this example, home value $500,000, purchase price, you'd get a first mortgage for $400,000 and a loan or the down payment assistance loan for $100,000. Let's say 5 years later, you sell a home. You sell it for $640,000. You bought it for $500,000. You sell it for $640,000. That $140,000 is the home appreciation. Since you fall in the low income category, we use 15% of that to pay your share of the appreciation. So 15% of 140,000 is 21,000. So when it's time for you to pay back that loan, you're going to need to pay back 121. 100,000 that you initially borrowed plus your share of appreciation. 140,000 times 15% is 20,000. Sorry, 21,000. Homeowner equity in this example would be 149,000. Let's say you make a little bit more income. You fall in that moderate income. How does that affect things? Everything else is the same except this appreciation, shared appreciation is 28,000, is because instead of taking 15% of this number, we're taking 20. So the lower income borrowers have a little better program. We talked about sale of a home triggering the repayment. That's probably going to be the most common, but here's some other things. So sale or transfer of the home, it's going to be what we call a maturity event. That's going to require you to pay back that initial down payment, whatever it is, plus your shared appreciation, all in a lump sum. It'll be due immediately. So sale or transfer, paying the first mortgage off in full, paying the down payment off, or in certain cases, if you're refinancing, it's going to trigger that as a maturity event. So let's say you buy a home for 500,000. It goes up to 1.8 million, which is not unheard of in California in some markets, where you're going to have 1.3 in appreciation. Well, the good news is the shared appreciation is capped at 2.5% of whatever you borrow. So 500,000, this person borrowed 100,000, 2.5 times 100,000 is 250. So when that maturity event kicks in, they sell the home, transfer the home, etc. They're going to pay back the initial 100. You always pay that back plus 250. They're going to pay back a total of 350. What if they pay part of the down payment loan back, but not all of it? In this case, 500,000, they borrowed 100,000, they paid back 75,000. Then they waited 3 years, then they sold the home. Does that help reduce the shared appreciation? The answer is no. You're going to have to pay that shared appreciation from 500 to 800, right? 300,000. They're moderate income. So we multiplied the 300,000 times 20%, 60,000. Plus you paid back 75. You still owe 25. So 60 plus 25, 85,000. What if it goes down in value? Well, you don't have shared appreciation because there's no appreciation. It decreased in value. You still have to pay back the loan that you borrowed, though. What if you buy a home for 500,000? You put 200,000. Home's now valued at $1 million. Do you deduct that 200,000? No, you're still going to have the same shared appreciation. How do you determine the value? If you're not selling, then it'd be an appraisal. What are the pros? The main pro is initial lower payment. You're going to benefit two ways. Lower first mortgage. You're not going to make payments on a portion of your purchase price, and you're going to avoid more mortgage insurance. Another benefit is you may be, because of the lower payment, eligible for a larger home, a more expensive home, may meet your needs a little better. Also, if the market's going up in value, what's going to benefit you more? If homes are going up 10%, a $100,000 home or $1 million home. So in an appreciated market, the higher purchase price would benefit you as well. No mortgage insurance not only helps you with the lower payment, but your money's going to principal and interest, not to a third-party insurance. And if the home doesn't go up in value, you don't have to worry about shared appreciation. What are some of the cons? Cons, as we try to explain in detail, you're sharing that appreciation. So if homes are going up in value, homes double that part that went up, you're splitting a percentage of that with CalHFA. The program has maturity events that force you to pay back and in full. It'd be a lot more convenient if a maturity event happened and then you started making payments on it. But nope, they want that money as a lump sum. Also, there's a number of things that can trigger the maturity event. And hindering you to refinance in the future, especially in a market where we're predicting rates to go down, is definitely a con or a negative. And if values go down, you're not splitting the loss with them. You're still having to pay back the full amount, and you're eating the entire loss of the home. And there's no guarantee of getting selected in the home. My biggest concern with this program is people are going to be discouraged. They're going to be excited about the possibility about owning a home, buying a home, getting $150,000 that they don't have to make a payment on. If they don't get selected, I'm afraid they're going to be discouraged. Don't be that person. The best time to plant a tree is 20 years ago. The second best time is today. So hopefully you get selected, but if not, I hope you still move forward and try to purchase a home. So what are next steps? Receive a loan pre-approval. I can help you out with that. Once you're pre-approved, we'll register for a DFA voucher. That's basically putting your name in the hat. Hopefully you're selected for the voucher. If you're selected to receive a voucher, then it's you have to go out and pick a realtor. If you don't have a realtor you're working with, let me know. I had the privilege of working with a lot of top realtors throughout California, and I know which ones are familiar with this program, so let me know. If you have a realtor that you like and trust, and they're not familiar with this program, I can definitely train them on what's needed. So that shouldn't be a problem. Once you work with your agent, find a home, get in escrow, we'll submit a formal loan approval. Once the loan approval closes, you have loan docs you need to sign. You go to escrow. If any money is needed, if you're buying a extra large home or expensive home, then if you need to come up with money, you'll do that. And then your transaction closes, you get the keys, and time to celebrate. What can you expect to purchase if you make about $93,000? If you don't have any debt, no student loans, no car loans, and not a condo. This is a single family home. 650 payment on that would be about 3763. I'm using an interest rate of 6.375. That's as of February 2nd. Cal HFA is unique and where they post their rates, and any lender you use will have the same rates. Can I qualify? What would you qualify for 140? Again, single family home, not a condo, 840,000 purchase price. If you are buying a condo, or if you have a car payment, or if you have a car payment and student loan payment, then that purchase price will be less, 6.5%. So the moderate income is going to have a little bit of a higher rate. So at that rate, 42.47 for the loan amount with taxes and insurance, you're about 52.19. Some FAQs. Do realtors need to be approved? No. First steps, reach out to me, get you pre-approved. What if you have a unique situation? Reach out to me, I'll get you an answer. Can the DFA be forgiven, the down payment loan? No, it's not a grant. It's a loan. Can I buy a rental home for my first home? No, this is meant to move in as your primary residence. Is this a limited program? Yes and no. Funds are going to run out. The program is designed to work in perpetuity, but they're going to have to get the money back from people that are borrowing it, and there's really no incentive for them to pay that back early other than hitting one of those maturity events. Is it first come, first served? No, it's a lottery. Do you make payments on the DFA loan? The answer is no. So I hope you found that useful. Thank you for your time, and I hope you're having a great day.